a Russian dossier, 4 criminal indictments, 2 federal probes, a felony conviction, and now an assassination attempt, Trump remains standing. The political drama that surrounds the 2024 election was already at a fever pitch. And then, of course, Saturday, shots fired, 2 dead and others wounded in a failed assassination attempt that rocked the nation to its core. Look, I know followers of this podcast come from both sides of the political aisle. But I also know many of you have money in the market. And while Americans will head to the polls in November, markets are already placing their bets, and it's a financial imperative that you add the political calculus to your decision process. Welcome to The Money Runner. I'm David Nelson. Even before Saturday, markets were already in the middle of a massive rotation that was triggered by a better-than-expected CPI last Thursday. Immediately, interest rate bets started to shift to a likely Fed cut in September. And today, markets are saying a September cut is a lock. In fact, Goldman is on record saying that July's meeting is live, believing it is possible they may cut even sooner. Markets are clearly pricing in a Trump victory. And on the other side of the ticket, President Biden is battling increased calls from members of his own party to pass the torch. This includes sitting House and Senate members, along with high-profile party donors. If Trump wins, the business environment will change significantly. The regulatory backdrop will loosen, which would be welcomed by business leaders across the spectrum. Trump's policies on energy, the dollar, geopolitical relations will differ starkly from the current administration. His views on taxes and the administrative state are the polar opposite of current policy. Key sectors that will benefit from a Trump victory include the following. Energy. While energy prices may not rise given the supply increase, don't forget the SPR needs to be refilled. Here's where I come out. Any rational view of a greener society has to include fossil fuels, at least until these alternative energy platforms can scale enough to handle the base load. Financials, another obvious choice, and a direct beneficiary of a lighter regulatory touch. If a Trump presidency comes to pass, expect increased M&A activity. The Biden administration has sought to curtail almost every announced merger. Executive orders and the politics that go with them still have a direct influence on capital markets. Thursday trading saw tech slayers get slammed on the heels of comments attributed to the Biden administration calling for tougher trade rules on Chinese access to advanced semiconductor technology. All in, semiconductors were down about 7% in one of the worst slides in years. First thing I did when I got to the trading desk was look at every semiconductor stock I owned and look at how much exposure they had to China. For most, it was significant, but still some had more than others. Semi-cap equipment stocks like Applied Materials came in at 27%, Broadcom 32%. Micron comes in at about 14%, so I did a swap selling some of the high exposure names to move into semis with less. This week's market action isn't just about the Trump trade. The massive rotation out of large cap secular growth into small and mid cap shares continues, upending the heavy concentration in today's market cap weighted indices. For the better part of a year, investors and portfolio managers have been waiting for this trade to unfold, but each time, it failed to follow through. How many times over the last year have we seen the probability of a rate cut climb high enough for many, including yours truly, to make the wrong call that the small cap trade was underway? The violence of the move, at a minimum, deserves our respect, and I've taken some actions to that end. The performance spread between mega-cap growth and the Russell 2000 over the last week is pushing 800 basis points. That's massive. So don't chase. Reversion to the mean is a powerful force. You'll have an opportunity to scale in at a better price. Markets are all but pricing in a Fed cut by the September meeting. That's the good news. The bad news is that if history is a guide, then the next logical event is a recession. While the timing's uncertain, the outcome seems predictable. Over the last half-century, only once has the beginning of a rate-cutting cycle not been followed by a recession, and that was in 1984. Why? Because the Fed always starts cutting too late. The rotation trade is well underway, but here's one mega-cap growth stock you shouldn't sell. In fact, you may not own enough. Apple is one of the most popular stocks on the planet, and few funds don't own it. But when you dig down into the portfolios, you can see most are underweight. Apple's close to 7% of the S&P 500, but most funds own significantly less, maybe even half. My research points to 1.46 billion iPhones globally. Apple's new AI rollout, Apple Intelligence, will only work on the iPhone 15 or later, rendering 1.3 billion iPhones obsolete. This will drive the mother of all upgrade cycles and will likely play out over the next few years. Personally, I usually skip a few generations of iPhone upgrades, but the new AI features compel me to buy the iPhone 16. Be honest, I think most of you will too. That's it for this week. I'm out of charts, out of time. If you like the pod, do us both a favor, hit subscribe, and please visit my Substack site, The Money Runner. Lots of extras there too. DCNelson123 at Substack.com. I'm David Nelson, and this is The Money Runner.